Welcome to the deep dive. We've got a really fascinating set of sources today, digging into Protector Forsikring ASA, that's PROT.OL, on the Oslo Exchange. It's an insurer, but one that's really shaking things up.
Yeah, it's a great case study. We're looking at a deep investment analysis of this specialized Norwegian non-life insurer. They actually call themselves the Challenger.
And that's our mission, isn't it? To get beyond the surface numbers. Protector's been delivering, well, frankly, industry-leading profits and growth, despite competing with absolute giants like Aviva or Gjensidige. How do they do that?
Exactly. And maybe the bigger question is, why does the market value them so highly? Almost like a tech stock, not an insurer. Is that premium justified?
That's the core tension, yeah. It's perfect for a deep dive like this. Insurance, I mean, it's usually seen as mature, cyclical, maybe a bit boring.
Modest returns, generally.
Yeah.
But Protector, they've shown, over a decade of really exceptional growth and, frankly, staggering financial results, especially on the return on equity side.
So to figure out if that market premium makes sense, if it's sustainable, we really need to get under the hood.
We do. We need to dissect the strategic choices, the operational philosophy that lets them stand out so much from the pack. It's not just luck.
Okay, let's start there. Let's unpack this whole challenger identity. What does it actually mean in practice? Reading through the analysis, it's clear the challenger isn't just some catchy marketing slogan. It seems to be baked into how they operate.
Oh, absolutely. Founded in Oslo, 2004. Purely non-life insurance, property and casualty, or P&C. But yeah, the challenger thing is about how they compete. It's built on operational efficiency, unique relationships, and finding cost-effective ways to deliver.
So not trying to be everything to everyone.
Definitely not. They made a very deliberate choice early on to avoid the mass market, the sort of general consumer stuff. They carved out a niche.
A specific moat you could
Exactly. They focused almost entirely on B2B business to business, and specifically the public sector. That's their stronghold.
Okay, let's get specific then. What kind of businesses are we talking about?
Well, on the commercial side, they go for medium to large companies. Think premiums maybe between NOK 100,000 and 3 million a year. So complex underwriting, not simple stuff.
Right.
But the real core, the secret sauce, maybe, it's the public sector. They are dominant in insuring Scandinavian municipalities, over 600 local governments.
Wow, 600.
Yeah. And crucially, they managed to take that playbook to the UK. Now they're a top 3 player there in public sector and social housing. We're talking over 420 clients, including like 181 local authorities.
That's huge concentration, especially in the UK. Why is that public sector focus such a big deal? Why is it a sustainable advantage, a moat?
Yeah, this is really the aha moment when you dig into it. Public sector insurance isn't just about being the cheapest. The tender processes are incredibly complex, often multi-year deals.
Right, lots of hoops to jump through.
Exactly. And they require really specialized expertise, particularly in liability. Think about insuring schools, infrastructure, social housing. The risks have long tails. So these clients, they value reliability, deep sector knowledge, and proof you can handle claims well, often more than just the absolute lowest price.
So it's sticky business. Once you're in and doing a good job, switching providers is a major headache for the client.
Precisely. Protector builds up this track record, this expertise. It makes them the go-to for specialist brokers who handle this stuff. The brokers trust them. So Protector gets first look at the best risks. It creates this self-reinforcing cycle, a generalist insurer trying to break in. It's incredibly hard.
And this discipline, this focus, it shows up in what they don't do, too. The sources really highlight their exit from the change of ownership insurance market COI back in December 2018.
Oh, yeah. It was a massive signal, a really defining moment. COI was, believe it or not, their only direct-to-consumer product.
Really? The only one?
The only one.
Yeah.
And it just wasn't performing well. High volatility, weak results, so they cut it. Just like that.
Wow.
It showed everyone, look, management is laser-focused on the core B2B and public sector business, where they have that edge. They're willing to ditch volume, even significant GWP, if it doesn't meet their profitability hurdles. Ruthless discipline, really.
Okay, so they're focused. But how do they deliver? How do they achieve that cost and quality leadership the analysis talks about, the thing that generates those outsized returns? Seems like there's a kind of operational trifecta.
That's a good way to put it. This trifecta is the engine behind their cost advantage. First up, broker-centric distribution. They only work through selected brokers. No direct sales force, no big marketing campaigns to consumers, no expensive branch network.
So huge cost savings right there. But it's more than just cost, isn't it? It's a partnership.
Absolutely. And it's working. I mean, the
Yeah.
proof is in the pudding, right? They're ranked #1 in the 2025 UK Broker Satisfaction Index. That's a highly competitive market.
That's impressive.
It means brokers trust them. They know Protector can handle complex stuff, pay claims fairly. So Protector becomes the preferred carrier for the quality business brokers want to place. It's an intangible asset, that relationship.
Okay, broker-centric distribution is one. What's the second part of this trifecta? It sounds like it tackles a big problem for older insurers.
Yes, exactly. Technology. The second pillar is their proprietary in-house IT. This might be their single biggest long-term advantage.
How so?
Well, think about the big established insurers. Many are stuck with ancient IT systems, right? Stuff built decades ago, patched up, reliant on expensive external vendors. It's a nightmare.
Yeah, the dreaded legacy systems.
Precisely. Protector sidestepped all that. By developing and maintaining their core systems internally, they get two massive benefits. One, a durable cost advantage that they're not paying huge license fees to vendors like Guidewire or whoever.
Right, and spending millions on integration every few years.
Exactly. And two, they get incredible agility. They control their own tech destiny. Need to change pricing models, adapt to new regulations, launch a new product feature. They can do it much, much faster than competitors wrestling with outsourced, clunky systems.
Okay, that makes sense. In-house IT gives them speed and lower costs. What's the third leg of the stool?
It's about quality control at the sharp end, internal claims handling.
Ah, so they don't outsource claims.
Nope, they keep it in-house. For those B2B and public sector clients, especially with complex liability claims, the quality of the claims service is absolutely paramount. Keeping it internal ensures they control that quality.
And presumably, they learn from it too.
That's the other crucial bit. They get direct, real-time feedback from claims data. If they see a spike in, say, specific types of liability claims from a certain municipal activity, their underwriters know instantly because they control the IT.
They can adjust pricing or policy terms almost immediately.
Bingo. It closes the loop. It helps them stay ahead of trends and maintain underwriting profitability. It's what they call the win-win-win. Good for the customer, good for the broker, and obviously, good for Protector.
Okay, so this focused model brokers, in-house IT, internal claims, it sounds like something you could, well, replicate. And looking at their history, the expansion seems very methodical.
It really does look like a playbook, doesn't it? They started in Norway, obviously, back in 2004, got that working well. Then, carefully, step by step, Sweden in 2011, Denmark in 2012.
Testing the waters in the Nordics first.
Exactly. Proving the model wasn't just a Norwegian fluke. Then came the big test in 2016, launching in the UK and Finland simultaneously.
And the UK, based on the numbers, was a huge success. It wasn't just a small side operation.
Not at all. The UK became the growth engine. It proved their niche focus, especially the public sector expertise, could work brilliantly outside the Nordic cultural context. As of year-end 2023, the UK was generating, 41% of their total gross written premiums?
41%, that's massive. It completely validates the scalability of the strategy.
It really does. And the overall growth numbers are, frankly, startling for insurance. We're talking a compound annual growth rate, HEAGR, well north of 20% over the last decade.
Wow.
Yeah, GWP went from about NOK 2.8 billion in 2015 to a forecast of NOK 12.3 billion for 2024.
And crucially, the analysis points out this is all organic growth.
Yes, that's so important. They didn't buy their way to this size through expensive M&A. They won the business organically, proving the model attracts customers and brokers.
Okay, so the playbook works, but they're clearly not stopping. The analysis spends a lot of time on the next big move, France, launching in 2025. That feels like a major leap.
It's definitely the next major test. A huge market, complex regulations, different legal system. It's a challenge. But the sources show they're being very careful applying that exact same playbook.
So not trying to conquer the entire French insurance market overnight.
Absolutely not. They're targeting a specific segment initially, estimated around EUR 1.5 billion, and guess what they're focusing on?
Let me guess. Motor fleet and public sector social housing.
You got it. Sticking to their knitting. Underwriting only what they know deeply. The initial focus is very much on municipalities and social housing, plus some commercial motor fleet business.
But how do you transplant the culture? The analysis mentions this one-team approach, sending French hires to train in Copenhagen or Manchester. Does that really bridge the gap? Seems like a big risk.
It is the key execution risk, no doubt.
Yeah.
And that one team thing is their attempt to mitigate it. The idea is to deeply embed the new French team in the existing Protector way before they really ramp up in Paris.
So it's about instilling the underwriting discipline, the cost consciousness, getting them used to the IT systems.
Precisely. It's culture transfer, trying to ensure the French unit doesn't drift off strategy and replicates the successful lean model from day one. It minimizes the chance they make costly mistakes early on.
Are there any early signs? Is it working?
Well, the very early signs seem positive. The analysis notes they'd already secured EUR 25 million in new sales commitments for the January 1st, 2025 start date. That suggests brokers in France are receptive, they see the value proposition.
Okay, 25 million euros is a decent start.
It is. And management isn't expecting miracles overnight. They're guiding that they expect the French operation to reach critical mass, basically, cover its own costs within about 3 to 4 years.
So they're playing the long game. They're willing to invest, absorb some initial costs to get it right.
Exactly. It shows strategic patience. They're not demanding instant profits from France. They want to build it sustainably, following the proven model. That discipline is key.
Okay, let's pivot to the hard numbers, the financials. Because even with a great model, insurance has bumps. And the analysis shows Protector hit some turbulence, particularly around 2018, 2019.
Yeah, you can see it clearly in the net income figures. While GWP was climbing, they actually posted a net loss in 2018 and were only around break-even in 2019.
What drove that dip?
It was largely a period of necessary pain, really, cleaning house. Two main things hit them. First, they had to significantly strengthen reserves, especially for some troublesome Danish workers' compensation business.
Reserving issues, the classic insurance problem.
Exactly. And second, remember that COI exit we talked about?
Right, the direct-to-consumer product they cut.
Well, exiting that wasn't free. There were runoff costs and final claim settlements associated with it. So those two factors really hammered the bottom line in those years. It was a short-term hit for long-term health.
Makes sense. And since then, the rebound looks pretty strong and consistent.
Very much so. Net income backs up strongly, hitting over NOK 1.5 billion in both 2023 and forecast for 2024. And the key metric everyone watches in this industry, the combined ratio.
Which is losses plus expenses as a percentage of premiums.
Right. Their target is consistently below 91%. That means they aim to make a solid underwriting profit before any investment income. A 91% target is ambitious, but achievable for a disciplined player.
And this is where that operational trifecta we discussed really shows its value, isn't it? Particularly on the expense side.
Absolutely. This is where Protector truly shines and where that premium valuation starts to make sense. Their cost leadership is undeniable.
Okay, give us the numbers. How much better are they?
Look at 2023. Protector's net expense ratio was 10.8%. Now compare that to their big Nordic rivals. Gjensidige was at 14.2%. Tryg was 13.4%.
So roughly 3 to 3.5 percentage points lower. That doesn't sound like much.
But on billions in premiums, that difference is massive. It drops straight to the bottom line as underwriting profit. It's a huge structural advantage that compounds year after year.
Is there a number that really drills down to the core efficiency, stripping out things like broker commissions, something that shows the power of that in-house IT and lean model?
Yes, there is. And it's quite remarkable. The analysis highlights their core internal cost ratio, excluding commissions, was just 6.4% in 2023.
6.4%.
Yeah. Think about that. Running the entire insurance operation, underwriting, IT, claims admin, compliance, everything except paying the brokers for just 6.4% of the premiums earned. That is incredibly low compared to traditional insurers carrying layers of management and legacy costs. It's the direct result of their model.
Wow. Okay, that paints a clear picture on cost. But efficiency can't control everything. The loss ratio part of the combined ratio, that's where the volatility comes in, right?
Yeah.
External events, claims.
Exactly. You can be the most efficient operator in the world, but you still face claims risk. We saw that in 2019 when their overall CR spiked to 103.8% because of those Danish issues and the COI cleanup. They actually paid out more in claims and expenses than they earned in premiums that year.
And more recently, have there been bumps?
Oh, yeah. Insurance is never smooth sailing. Q2 of 2024, for instance, their quarterly CR jumped to 94.5%. That was driven by some large property claims. Remember the big fire at the historic old stock exchange, the Børsen in Copenhagen?
Yes, that was major news. They were on that risk.
Apparently so. That, plus the impact of storm Hans in Norway, pushed claims costs up in that quarter.
So they're not immune to catastrophes or large single losses.
Nobody is. But what's also notable is how they seem to bounce back. The next quarter, Q3 2024, the CR was back down to a very strong 83.2%.
That's quite a swing.
It shows resilience. Their lean structure and control over their IT likely allows them to react quickly, adjust pricing, tweak underwriting where needed to get back on track faster than some others might.
Okay, so cost leadership, managing volatility, it all feeds into the ultimate measure for shareholders, return on capital. And this is where Protector really stands out, isn't it?
Probably their most impressive metric,
Yeah.
the return on equity, ROE. In 2024, they delivered 31.6%.
31.6%. That's astronomical for an insurance company.
It really is. It's way above their own long-term target, which is already ambitious at 20%, and it leaves most peers in the dust. Gegensidige, which is a very strong company, was around 27.4%. Drag was down at 12.9%.
When you're compounding shareholder capital at over 30% a year, well, you can see why the market gets excited and applies a premium valuation.
Precisely. That ROE is the justification for the high PB multiple. And this financial strength isn't just internal math. It's getting recognized externally, too.
You mean like their capital adequacy ratios?
Yeah, their Solvency II SCR ratio, that key regulatory measure of capital health, is consistently strong. Around 193, 196%, comfortably above their 150% target. They are very well capitalized.
And the rating agencies are noticing.
Big time. AM Best, the main insurance rating agency, gave them a significant upgrade in July 2025. They listed Protector's financial strength rating from BBB+, good, up to date.
Excellent, an A rating. That's a big deal, isn't it? Especially for their target market.
Huge. For landing those large multi-year public sector contracts, especially in new markets like France, having that A stamp of approval is incredibly valuable. It signals financial strength and reliability, which is exactly what those big clients look for. It reduces friction in winning new business. Okay, so Protector's firing on the cylinders internally, great ROE, strong capital. But they don't operate in a vacuum, right? They're facing the same big, challenging macro trends as everyone else in the P&C industry.
Yeah, let's talk about those headwinds. The regulatory environment seems particularly tough lately.
It's been relentless. Insurers globally have had to grapple with massive accounting changes, IFRS 17 and IFRS 9. IFRS 17, in particular, totally changed how insurance contracts are accounted for, much more complex, impacts capital. There's been a huge lift.
On top of the existing capital rules.
Exactly. You still have the stringent Solvency II capital requirements in Europe. And now, growing pressure on the ESG front, things like the Corporate Sustainability Reporting Directive, the CSRD, demanding incredibly detailed disclosures on environmental and social impacts. All this adds cost and complexity.
And then there's the economy. Inflation has been a major headache for insurers.
A massive one. Claims inflation of the rising cost of materials for repairs, labor, car parts. It's been persistently high. It means insurers have to be really disciplined about pushing through significant premium increases just to stand still on margins.
If your claims costs go up 8%, you need rate increases of at least 8% just to maintain your loss ratio.
Precisely. It's a constant battle. And then layered on top of that is climate change.
Making extreme weather more frequent and severe.
Yeah, we're seeing it in the data. Events like Storm Hans, which hit them in 2024, are becoming more common and more costly. Puts pressure on loss ratios, makes catastrophe modeling harder, and drives up the cost of reinsurance, which insurers buy to protect themselves.
And one more cycle to think about the insurance market cycle itself. It's been a hard market for a while, right? Meaning rising prices.
Yes, for several years now, insurers have generally had more pricing power. Rates have been going up, underwriting discipline has been tight. That's the hard market.
But the analysis mentions potential signs of a shift towards a soft market.
Yeah, there's chatter among brokers and in the market that we might be heading towards, or maybe are already entering, a soft market phase. That means more competition, maybe excess capital entering the market, and potentially falling premium rates as insurers fight for volume.
And that would be a major test for Protector's profitable growth mantra.
A critical test. If competitors start slashing prices to grab market share, Protector, with its strict profitability targets, like that sub-91% CR, will have to be willing to walk away from business, even if it means slower GWP growth. Can they resist the temptation to chase volume in a softening market? That's a key question.
Okay, those are the external pressures. What about internal challenges? Is everything running perfectly within Protector? Management seems quite open about some issues.
Yeah, which is good. You want that transparency. They've specifically acknowledged that their motor insurance portfolio is currently underperforming across all their countries.
So car insurance, basically.
Right. Commercial motor fleets, mainly. They admitted that the price increases and other actions they'd taken previously were insufficient to get the profitability where it needs to be. They're still struggling a bit with claims frequency and severity in that line.
Why is motor tougher, do you think?
It's often more competitive, very price sensitive, and maybe claims trends like parts costs or accident frequency can move faster than in, say, property lines. Getting the pricing right consistently is tough.
So what's the main tool management is using to fight back against inflation and fix that motor book?
Price. Aggressive, targeted repricing, leveraging that agile IT system we talked about. The data shows they're pushing through substantial rate increases on renewals, consistently reporting renewal retention rates well above 100% when you factor in the price hikes.
So they're not shy about raising prices even if it means losing some customers.
Seems like it. They have to protect that underwriting margin, especially with inflation running high. It's a constant race.
One last piece here, their investment strategy. The analysis notes it's a bit more, shall we say, active than many peers.
Yeah, that's fair. While a lot of conservative insurers mainly stick to safe government bonds, Protector takes a bit more risk, aiming for higher returns. They had about 15.1% of their portfolio in equities as of Q3 2024.
15% in stocks. That's quite punchy for an insurer.
It is. And within their bond portfolio, they also have a noticeable slice, around 19% allocated to high-yield bonds, which carry more credit risk but offer higher potential returns.
So this more opportunistic approach helps juice the overall returns, contributing to that high ROE.
Definitely. The investment income component is important for their overall results.
But it also adds another layer of volatility, doesn't it? If the stock market tanks or credit spreads widen, their earnings could take a hit unrelated to their insurance operations.
Absolutely. It's a calculated risk. It exposes their results more directly to capital market swings. So while it boosts returns in good times, it can amplify losses in bad times. It's something investors need to be aware of, that added volatility from the investment side. Okay, so we know they generate a lot of capital thanks to that high ROE. How do they decide what to do with it? Their capital allocation philosophy seems very dynamic.
Yeah, it seems clearly linked back to that growth strategy. What's the #1 priority for their capital?
Profitable growth. Absolute number one. Deploying capital into high-return insurance opportunities. The French expansion right now is the perfect example. That's where the capital needs to go first.
And only after those growth needs are met, they think about returning cash to shareholders.
Exactly. And that decision is guided primarily by their solvency second SCR ratio. If their ratio is comfortably high, well above their target, and they don't see immediate, compelling, high-return growth opportunities to invest in.
Then capital comes back out as dividends or maybe buybacks?
Precisely. They have these internal zones for their SCR ratio. If they're in a high zone, distribution is more likely. If they're building capital for something big, like France, they'll retain more.
And that flexibility shows up in their dividend policy, right? It's not a fixed amount.
Not at all. The official policy allows for a payout ratio anywhere between 20% and 80% of net income. And they use both regular dividends and, importantly, special dividends to manage this.
Like that NOK 5.000 per share special dividend in late 2023.
Exactly. It gives them the ability to return significant cash when capital levels are strong and growth needs are met, without committing to an unsustainably high regular payout. It's smart, flexible capital management.
And this brings us to that really telling anecdote from Q3 2024. It seems like a perfect example of their discipline in action.
Oh, yeah, that was a bold move. They decided to withhold the dividend entirely for that quarter.
Which probably didn't make all the income investors happy.
Probably not. But management was explicit about why. They directly cited the increased probability of growth in France as the reason for keeping the cash in the company.
Wow. So they basically told shareholders, look, funding this French launch is a better use of this capital right now than giving it back to you.
That's exactly the message. It shows absolutely perfect alignment with their stated philosophy. Profitable growth comes first. Payouts are what's left over after funding that growth. It takes real conviction to make that call, especially when your stock price is high.
It really underscores that long-term compounding mindset. And speaking of alignment, the insider ownership seems pretty strong too.
It does. That's often a good sign for governance. The CEO, Henrik Høye, owns around 0.34% of the company. That sounds small, but given the market cap, it's worth over NOK 135 million.
Okay, that's significant skin in the game.
And the founder and chairman, Jostein Servold, owns about 0.6%. When management has a substantial personal stake, their interests are generally well aligned with long-term shareholders. They're focused on building sustainable value, increasing book value per share, not just hitting quarterly targets. Okay, we've painted a picture of a really high-performing company with a strong model, great returns, disciplined management. But now we have to temper that with the risks, because no investment is risk-free, especially one with such a high valuation.
Right. Let's catalog the main vulnerabilities highlighted in the analysis. What are the big ones?
First, there's concentration risk. We celebrated the UK's success, but having 41% of your business tied to one single market? That's a significant dependency.
So if something goes wrong specifically in the UK, a regulatory clampdown on public sector insurance, a sharp economic downturn there, it hits Protector disproportionately hard.
Exactly. It makes them vulnerable to localized shocks in the UK. Second, and we touched on this, is execution risk, specifically around France.
The big bet.
The big bet. It's their single largest operational undertaking right now. If they misprice the risks in France, if they can't win over the brokers, if that one-team culture transplant doesn't quite take, it could become a real drag on group results and absorb a lot of capital for potentially little return.
And then there are the fundamental risks of just being an insurer.
Always. Underwriting and reserving risk. We already know they're battling profitability issues in motor. That highlights the constant danger that your pricing falls behind claims inflation, and maybe even more insidiously, for those long-tail public sector liability lines, there's always the risk that the reserves you set aside today turn out to be insufficient years down the line when claims actually emerge. That can lead to nasty surprises hitting the P&L.
Okay, so significant risks remain. Which brings us back to the elephant in the room, that valuation. Why is the market paying such a premium?
It is a steep premium. The price-to-book ratio, PB, is sitting around 6.4x based on recent data.
6.4, how does that compare?
Well, Tryg, another Nordic insurer, trades around 2.6x PB. Gjensidige, also very highly regarded, is closer to Protector at maybe 6.1x, but still slightly lower. And maybe more telling, Protector's own PB was only 3.28x at the end of 2023.
So the multiple has nearly doubled in less than a year.
Pretty much. The market has aggressively re-rated the stock upwards.
Okay, so why? What's the justification the market is clinging to for that kind of multiple in a sector like insurance?
It boils down almost entirely to one thing: that stellar, sustained return on equity. Yeah. The 31.6% ROE.
The compounding machine.
Exactly. The market sees a company that can consistently generate returns on its capital base at more than double or triple the industry average. It views Protector as a best-in-class compounder of shareholder value. That high PB multiple is essentially the price investors are willing to pay to own a piece of that exceptional compounding engine, betting that it will continue.
Right. It makes sense intellectually, but it feels precarious. Let's try to synthesize the bull and bear cases clearly for the listener weighing this up.
Okay. The bull case goes like this. Protector is a uniquely advantaged business. They have a proven, repeatable strategy focused on defensible niches. They have a durable cost advantage from their proprietary IT. They generate industry-leading ROE, which fuels rapid compounding of book value. Management is disciplined, aligned with shareholders, and they have a clear growth path ahead with the French expansion. The recent A rating validates their strength. It's a premium company deserving a premium multiple.
Okay, that's the optimistic view. What's the bear case? What keeps a skeptic up at night?
The bear case is simple. The valuation is already pricing in perfection. At 6.4x book, there is absolutely no room for error. Any significant stumble, maybe France doesn't work out as planned, maybe a couple of really bad quarters push the CR above 95%, maybe the market softens dramatically and growth stalls, maybe a huge catastrophe loss hits them. Any of those things could shatter investor confidence.
And lead to a rapid derating. The multiple collapses back towards the industry average.
Exactly. You could easily see that 6.4x PB fall back to 4x or even 3x very quickly if the narrative of flawless execution breaks. The downside risk from the current valuation level is significant if anything goes wrong.
So for someone tracking this, maybe invested, maybe just learning from their model, what are the absolute key metrics you need to watch going forward? The canaries in the coal mine.
I'd watch three things relentlessly. First, the combined ratio, quarter by quarter, especially the numbers coming out of France once it gets going. Does it stay consistently below that 91% target? Any sustained creep outwards is a major warning sign.
Okay, CR is number one.
Second, gross written premium growth. Is the organic growth engine still firing, especially in France? Or are they seeing growth stall significantly, perhaps because they're walking away from business in a softening market? You want to see profitable growth, but growth is part of the story here.
Got it. CR, GWP growth. What's
Yeah.
the third?
The big one, return on equity. That 31.6% is phenomenal, but is it sustainable? A sustained drop below their own 20% long-term target would be the biggest red flag of all. It would signal that the core compounding engine, the very thing justifying the premium valuation, is starting to sputter. Hashtag tag outro.
Well, that really covers a lot of ground. We've gone deep into how Protector, this challenger, has managed to punch way above its weight. It's not about size, is it? It's about focus, niche domination, that unique operational setup with the in-house tech, and those crucial broker relationships.
Absolutely. They've built a model that delivers a massive cost advantage and, as a result, truly extraordinary profitability and returns in a sector that's often seen as, well, pretty pedestrian.
I think the big takeaway from this deep dive, for me at least, is how much value can be hidden in intangible assets, things that don't always show up clearly on a balance sheet.
That's a great point. That's specialized underwriting knowledge in public sector risks, the efficiency baked into their proprietary IT platform, the loyalty and trust they've built with brokers. Those are the real engines driving that 31.6% ROE. They're hard to measure, but incredibly valuable.
So we end where we began, really, with France. It's this huge strategic bet, doubling down on their belief that this culture, this expertise can scale again. We even saw how management explicitly held back a dividend to fund it.
A very deliberate choice.
So the final question for you, the listener, to chew on, is the potential upside from cracking the French market worth the extremely high price the stock market is already charging for that expected success today? Given that 6.4x price-to-book multiple, what level of execution risk are you comfortable with? Because it seems Protector needs to execute almost perfectly just to stand still on that valuation.